welcome to Market Domination. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We got 1 hour to go until the market close. So let's take a look at the major averages where a rally is largely holding for the moment. A rally that was spurred initially by a milder than expected consumer inflation reading this morning. So let's get to the numbers here. We got the Dow right now up around 60 points or so, but we have seen it sort of bouncing around between gains and losses today. It's of the major averages doing the worst. The S&P 500, its gains more solid, although we still see that volatility that we have come to expect now on an intraday basis, but it's up 0.8%, and the NASDAQ is up 1.4%.
We had 2 days of heavy losses, Julie. We deserve to see a little green on the screen. You mentioned that CPI print, which was cooler than expected. You did see, importantly there, that kind of just outsized drop in airfares, and that certainly helped. That does not, of course, flow into PCE, which is the Fed's preferred inflation gauge. We're going to get that later this month, but I don't want to overthink it. I mean, bottom line, I think investors saw that, and you did see this kind of sigh of relief.
Right. They were looking for a reason to maybe come back into the market here. Look at some other assets, too. I think it's worth mentioning, not surprisingly here, we've got volatility back down, although 24 is still a relatively elevated level. It's worth mentioning that. We got also 10-year yields coming back up a little bit, not a very big move there, it should be noted. And then we also continue to watch what's going on with some of the commodities. We've got oil bouncing today. I mean, you were talking about the selling that has been going on in oil. We definitely have seen a lot of gyrations here and some recent weakness. Gold futures coming up today as well. People coming back into gold, which is interesting because while you've got risk on, you wouldn't necessarily expect gold to be doing well, but shows that people are maybe looking for a little. It's
interesting, though, Julie, that you and it's a good thing to note gold too, because I do think, listen, if you're watching this and you're a viewer, I mean, we hammer on U.S. stocks, and rightfully so, but I mean, if you've been diversified, and that is like, what we all learn, personal finance 101, you stay diversified. If you were looking at gold year to date, if we were looking at Europe year to date, we're going to talk more to a guru about that later in the show, there are bright spots in people's portfolios that are worth highlighting.
Most definitely. And also, just to dig beneath the surface of stocks for just a moment here as well. First of all, we should say most of big cap tech, with the exception of Apple, is higher today also. So we're seeing a bounce there. Tesla bouncing 8%. We're going to dig into that a little bit later. Nvidia up 6.5%. If you look at the sectors in the S&P 500, most of them are higher. Consumer staples lower, but tech, energy, consumer discretionary are coming back for some recent losses. But when you talk about the year to date as well and where there have been wins, actually a lot of the S&P 500 is higher on the year. We've been pulled down by consumer discretionary and tech, but healthcare, energy, utilities, some of the more defensive sectors in particular have been doing a little better.
Let's get more on this, shall we? For more on the latest market moves, let's welcome in now Kevin Mon, Hennian and Walsh CIO. Kevin, it is always great to see you. So let's start with this sell-off that we have been seeing, Kevin. It's fast, it's furious, it's making headlines. As a long-time market watcher, Kevin, do you look at that sell-off and say, that is a buying opportunity? Do you say, you know what, I'm not comfortable here, I think there's more pain to come? What are you telling your clients?
Well, March Madness is clearly upon us. However, this year it started in the stock market as opposed to on the basketball courts, as investors continue to climb that wall of worry, whether it's over concerns on tariffs, whether it's over concerns about the slowing economy, whether it's over concerns about poor forward-looking guidance from corporations coming out of earnings seasons, or even potential overspends in the AI revolution. Check whatever box you want. That has all led to more volatility. But that volatility has also served as a reminder of the benefits of diversification, to the points in your opening piece, as we're seeing changes in market leadership. Technology is no longer leading the way. We're seeing areas such as value outperform growth. We haven't been able to say that for 2 years. We're seeing international outperform U.S. We haven't been able to say that in over a decade. And we're seeing sectors such as healthcare, staples, utility now start to provide growth opportunities. So to me, these periods of volatility serve as a very important reminder, not just to load up your portfolios in any one sector or any 7 magnificent stocks, but diversify beyond that.
It's funny, too, because we kept hearing the rally's going to broaden, the rally's going to broaden. But the key word there is not broaden, but rally.
Yes.
Right? I think that people expected things to keep going up, but go up in a more democratic fashion with more stocks participating. So now that things are all going down on the days that they're going down, Is there still, do you still want to load up in some of those diversified areas you're talking about? Is
Yes.
this the time, do you go into value? Do you go into healthcare, et cetera?
I think all those areas are an important part of any diversified portfolio. And I would suggest that we do want the rally to broaden, but not necessarily exclude the most important components of the stock market and the most widely held sector to most retail investors, that being information technology. But I still wouldn't count out the NVIDIAs of the world. I wouldn't count out Microsoft and the Mag 7. They're going to continue to lead this market forward, and I believe lead this bull market for the next couple of years. But they were overvalued. So they were due for a potential pullback and correction, perhaps creating even more attractive investment opportunities in those particular names. But again, look to diversify your portfolio into other geographies, in other styles, in other sectors. I think if you look in industrials, aerospace and defense, utilities from the AI perspective, and even other areas of information technology that benefit from the AI revolution, opportunities are there, and there will be more growth ahead once we get through this period of transition and this period of volatility.
There might be some folks, Kevin, who are watching this right now, though, and they're hesitant to slam a buy button on anything because of the degree of uncertainty coming out of Washington, because the Trump administration says, hey, they'll give you dates to circle on your calendar. They'll say April 2nd, reciprocal tariffs, right? And then after that fight's over, then we can fight over taxes after that. There's just so much uncertainty. I'm sure a lot of people just feel like, you know what, I'm going to sit on the sidelines until I just get more clarity.
Yeah, the only thing certain right now is that there's going to be more uncertainty. Right. But that level of uncertainty and these levels of volatility do create opportunity. And I would warn your viewers to be very resistant to the temptation to try and time the market, because when this market does bottom, the bounce back will likely be significant. History tells us that trying to time the market is an exercise in futility. I always go back to this one study done by a University of Michigan professor that looked at 31 consecutive years of stock market performance and found that 95% of the stock market returns come on just 1% of the trading days. Wow. Now, none of us know when those 1% of the trading days are going to be, but if you're not in the market on those days, you're likely to miss out on the most significant returns the market has to offer. So stay invested, stay true to your risk tolerance, and keep a longer-term perspective where appropriate.
I mean, I guess I won't ask you then when stocks are going to bottom, because that'll just go.
Pass.
But I will ask you this. Obviously, there is a lot of concern now around the tariffs, the effect that's going to have on the economy. We continue to see economic forecasts come down.
Yes.
Does the attention, to Josh's point, now go beyond the tariffs and focus on the tax cuts? And how pivotal do those tax cuts? So and I guess we're talking about two different things here. We're talking about an extension of existing tax cuts and potentially additional tax cuts. How important do those become?
If the tax cuts do not get extended, that is a game changer and would have a serious impact on economic growth. I still believe the tariffs are going to have more of a growth impact than they will have an inflationary impact. As I always use the example that a consumer has $100 to spend, and with that they can buy two goods worth $50 each. If prices go up to $60 each on both of those goods, well, guess what? They can't afford to buy both. So they buy one and they look for a more reasonable alternative to the other, or they keep that money in their pocket. If they keep that money in their pocket, that's going to affect the economy, because 70% of our economic growth comes from spending. So I think it creates more of a growth scare. But know who else thinks that way? The Federal Reserve, and they meet next week. So the Federal Reserve, I believe they're going to pause next week, but may very well come to the quote-unquote rescue to prevent this economic slowdown from becoming anything more severe by doing their first interest rate cut during the second quarter of this year, as opposed to the second half of the year, as many folks were thinking just about 2 weeks ago.
Right. Kevin, thank you so much. You're going to stick around and give us some
Yes, I am.
stock picks in goodbye in just a little bit. We're going to dive into the retail sector to talk about that when Kevin is back with us to help investors better position their portfolios. We'll have that. We'll have much more when Market Domination returns. It It is time for some of today's trending tickers. First up, we've got Intel. That stock is up today on a report that TSMC has pitched chip designers NVIDIA and Advanced Micro Devices and Broadcom about taking stakes in a joint venture that would operate Intel's factories. Joining us now with more, Yahoo Finance's Dan Howley. This is really interesting, Dan, because before there had been reports about maybe TSMC partnering with one of these, but that it's three maybe changes things.
Yeah, this would be a consortium kind of, Julie, of some of the biggest names in chips. And so, this kind of comes down to Intel's foundry being the laggard of the company, pulling it down and leading to some of its issues. Basically, during Pat Gelsinger's time, when he was trying to turn the company around, the idea was to use the foundry business as a third-party foundry for customer companies like the NVIDIAs or the Qualcomms of the world that don't necessarily build their own chips and need to contract those out primarily to TSMC. Intel wanted to be that kind of a rival to TSMC, and they've built up their own capabilities with their 18A chip, which they're still working with. There's been rumors that some companies are trialing the chip technology itself, NVIDIA and Broadcom among them. But it's been a real issue for Intel at the same time that the Trump administration and previously the Biden administration were trying to champion the company as the U.S.'s big premier chip maker, and it still is, but it's just fallen behind TSMC so much that the idea here would be for them to kind of come in with NVIDIA, Broadcom, AMD, and kind of prop up the Intel foundry, take it over and run it. But there are a number of issues here. Chief among them that the technologies that TSMC use and that Intel use are wildly different. Yes, they produce chips that can use the same kind of languages. That's x86, which is what AMD and Intel use, and TSMC builds a lot of AMD chips. But that doesn't mean that the processes are the same at all. So they would have to kind of do a lot of background work to ensure that they're able to work with Intel's technology and be able to run it efficiently. And the other thing is that, this is a company that TSMC that's already investing some $165 billion in building out their facilities in the U.S. Now, Intel is also building out facilities in the U.S., but it raises the question, okay, they've just announced this additional $100 billion in spending on plants in Arizona last week. What does that mean then about this consortium? And do they necessarily want to get involved in that when they're already laying out billions to put together these facilities in Arizona where they would have a bigger foothold in the U.S.? So I think it's still very much in flux. We reached out to Intel. They didn't have any comment on this. But, as you said, there were some companies that have already been spoken about potentially going after Intel, including Qualcomm, which works in the PC space as well as the smartphone space, and is looking to expand where it lays in the semiconductor business. So, there's a lot in flux here still. We'll just have to see what happens with Intel's foundry business. This doesn't mean that the design business is going anywhere, but there is continued chatter about this foundry, so we'll just have to see.
Big players, big story. Dan, thank you so much. Appreciate it. Our next trending ticker, iRobot. That stock is plunging today after it issued a warning in its earnings release that it has substantial doubt about surviving the next 12 months. So the board starting a formal strategic review, Julie, to think through options here, potential next steps, including refinancing debt, exploring a sale. Recall that Amazon, of course, abandoned plans to buy the company last year. That was after fighting with EU regulators who had threatened to block it.
Yeah, definitely. So not good news for iRobot. At the same time, the company is still pushing ahead. It introduced 8 new Roombas, which is its biggest product release ever in terms of the number of products. So it is hoping to still get a boost from that. And the company has been taking out some lines of credit. In fact, recently took out a line from Carlyle Group of $200 million a couple of years ago, but it was at a high rate of interest. So, we'll see what ends up happening with this, but it looks like it is possible that the company will go out of business.
And as for the financials, by the way, they reported a net loss of about $77 million in Q4. Revenue dropped about 44% from a year ago. Year-end, $134 million in cash or cash equivalents.
All right, well, Roche and Zealand Pharma inked a $5.3 billion deal Wednesday to collaborate on a weight loss drug and take on the likes of Novo Nordisk and Eli Lilly. Joining us with more, Yahoo Finance's Anjali Kamlani. So what's the drug? How is it different from some of the other ones?
Yeah, it actually is taking on more Novo than Lilly, and I'll get to why. So that $5.3 billion deal from Roche is for this drug, which is basically like a GLP-1. In the same way that the GLP-1s today mimic something in the body, this drug that Zealand has mimics a different hormone that is secreted at the same time as insulin. And so it's called amylin, and that's what the focus is this drug. There's your definition right there. So what Roche is looking at is either producing this treatment separately for amylin and co-producing, co-marketing, and getting the revenue off of that, or also using it with one of its GLP-1 candidates, which is currently in the pipeline. Right now, this drug is in phase 2, so waiting to see the rest of the data on how it stacks up. But the reason why this is important, especially for Novo, is because it's a new contender in the same space, especially if Roche decides to combine it with its own drug. Because just earlier this week, we got data from Novo Nordisk about its CagriSema drug, and that wasn't too impressive. And that's a similarly GLP-1 plus amylin dual combination drug. So that's why it's important for the comparison. If you see the stocks today, Roche up a little bit on the news, Zealand, of course, skyrocketing on the news, Novo the most impacted, even though Lilly did get a bit of a dip. So as you can see that on your screen. So that's sort of where we are and sort of how this stacks up. Analysts are still waiting to see exactly how the drug compares to Novo Nordisk's CagriSema, but also how it compares to the overall GLP-1 space. Do we still need, like I've said before, more drugs doing the same?
Interesting.
Very.
Thank you, Anne. Appreciate it. Well, the consumer price index for both all items and core increased 0.2% in February. That was slightly below, and that means better than expectations. The report provided some relief as consumers and businesses worry about the looming impact that tariffs might have on inflation. Joining us now, Jose Torres, Interactive Brokers senior economist. Jose, it is always good to see you. So now that inflation seems to be a little bit milder for February, does that mean that stagflation's off the table, that we're safe from that?
Julie, great to see you. Thanks for having me. No, the tariff implementation has not been widespread, and a lot of the actual levies have not commenced yet. So we have to wait and see what the potential inflationary impacts of those policies will be. Now, in the trading action today, we're seeing some interesting moves. Stocks went from strong gains to modest losses, back to green. But in the Treasury complex, who would have thought that a better than expected CPI across the board with broad-based deceleration would have led to higher yields today? So we're getting a little bit of a mix here, bifurcation of investor sentiment, where in equity land, folks are concerned about growth risks and a potential slowdown. But in the Treasury complex, they're still a little hesitant and reluctant to declare victory on inflation.
Jose, I'm just curious, as an economist, how you're thinking through tariffs and the potential impact there on that inflation trajectory ahead.
Sure, Josh. Great to see you. Well, a lot depends on the extent and duration of the tariffs, right? A 50% tariff won't have much of an impact if it only lasts one day. But if it lasts 6 months or so, then the impacts are much more significant. Now, starting the year, my economic growth forecast for 25 was at 3.3%. But in light of the heightening trade tensions and the talk continuing to become increasingly confrontational, my forecast now is down to 2%. We're seeing market volatility. Corporate fundamentals could be in question. Inflation could very well, we can see CPI back in the 3.5%, 4% year over year in the span of the next 6 months. So that would be very worrisome because that'll sort of take away the Fed put and take away the option for the central bank to come in and maybe start to support markets. However, our prediction markets, IBK, our forecast trader, still believe that we're going to get roughly 3 rate cuts this year.
I guess the question is, with rate cuts, how much can that offset the effect of, it's always hard to tell if you are entering an economic slowdown or a recession. How much does the Fed cutting offset that?
Sure. I mean, we've seen historically that if the Fed provides accommodation on the monetary policy side and then the fiscal side also offers some stimulus, that those forces could be quite buoyant. I mean, immediately after the pandemic, we saw that those measures really pushed economic growth north by a lot and produced elevated asset prices, in stocks and bonds, as well as in real estate and in other assets. So, the Fed coming to the rescue is definitely going to lift economic prospects shall they begin to weaken considerably. Remember in 2018-19 period, the Fed started reducing rates, and economic growth in the third quarter of 2019 ramped up to almost 5%. So those are really, really powerful factors. However, we're in a new regime now. If the Fed cuts, that's probably going to generate inflationary pressures. So that's the path of least resistance for policymakers, is accepting inflation instead of an economic slowdown.
Jose, on the Fed, it's interesting because there's other folks who argue that the Fed is just frozen in place for a while. And in part, they argue that, Jose, because they say President Trump, at any given moment, could just go on social media and say, you know what? I've been talking to Canada, been talking to Mexico, I've been talking to China. We made good progress. We got a great deal. I'm happy. They're happy. I'm calling off the tariffs. At which point, the economy rips, the markets rip. The Fed, their point is just stuck here because of that. What do you just make of that argument?
No, I mean, you're absolutely right. Josh, and the way I've been thinking about these things, you have the economic headwinds of trade policy, immigration restriction, as well as government spending reduction prospects weighed against the potential tailwinds of reduced taxation, a lighter regulatory regime, as well as a manufacturing recovery from an investment and employment side. So I'm sort of weighing the headwinds and tailwinds that way. Now, on the headwind side, if you tell me that we're going to have trade acquiescence, and that everything is going to be all good with Canada, Mexico, Europe. And you know what? We can probably afford to maintain tariffs on China. That's been ongoing for a long time. Even the Biden administration kept those policies. Then, Josh, you're absolutely right. That economic acceleration that I was looking for in the beginning of the year of 3.3%, earnings growth for the S&P 500, right? Then that case opens up. But right now, it just doesn't look like President Trump and the administration is looking to be collaborative. They seem like they're looking to be confrontational. They're looking to get significant wins for America. Of course, that dials up the risk of a slowdown and of price pressures beginning to reignite. Final point here, folks are more worried about the economic slowdown than price pressures because consumer spending decelerating, that in itself will probably weigh a good amount on inflationary pressures rather than continuing to have a robust economic growth cycle. And that is usually accompanied with stronger inflation because of higher demand.
So, Jose, given the concerns about growth, given the way the markets have been reacting to those concerns about growth, what happens if there's not A, an extension of the tax cuts, and or B, additional tax cuts, say, in the middle of this year?
That'll be problematic for markets, Julie. I think that in that case, the risk premium would have to increase. You would have to see significant earnings prowess to withstand that kind of environment. In fact, I'm ready to say if you don't have relief on the taxation front or relief on the trade front, that we're probably going to have a significant slowdown this year, probably down to 1% on GDP, could possibly go negative, and markets will probably have a little bit of a reprieve, a down year after 2023 and 2024 were up roughly 25%.
Jose, always good to see you. Thanks for joining us today.
Thank you, Julie. Josh, see you soon.
Energy prices edging higher in February with some relief in gas prices. Here with a closer look is Yahoo Finance's Inez Ferre. Inez.
Yeah, Josh, and we saw in that CPI print today that gasoline prices went down in February by 1%. On a year-over-year basis, gasoline is down more than 3%. In fact, today the national average is at $3.08 per gallon. That's lower than last year and also last month. When it comes to the index, though, as a whole, we are seeing that that index, the energy index, month over month, went up by 0.2%. And part of that has to do with natural gas prices, which are up month over month 2.5%, and electricity. A lot of the electricity in the U.S., of course, is derived from natural gas. I will say, if we just show on our interactive screen, that really among the energy players, natural gas is really the outperformer because oil is down year to date, but we are seeing that natural gas is up more than 11% year to date, guys.
Also, let's talk about another commodity, Inez. Gold prices have been rising amid tariff uncertainty. What are we hearing from Wall Street about gold?
Well, we have a new price target from BNP Paribas. They are now saying that gold is going to reach $3,100 in the second quarter of this year, with strategists there saying that the Trump tariff chaos really is driving up demand when it comes to gold. So that uncertainty around the tariff policy, that is adding another layer to boosting gold prices. So you're seeing gold futures up more than 10% year to date. Today, we saw gold futures going up as well. What he is saying, though, the strategist over there, David Wilson, is basically that in the second half of the year, gold is going to struggle going up above that level because gold prices will have already priced in that tariff uncertainty. And unless you have a tariff escalation going into the second half of the year, you won't be seeing prices going up that much higher. But certainly something that the street has been looking at, that 3,100 level, something also that Goldman Sachs is predicting by year end for sure.
Inez, thanks so much. Appreciate it.
Thank you.
Coming up, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the right moves for your portfolio. Stick around, much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal is to help cut through that noise to navigate the best moves for your portfolio. Today we're looking at retail as consumer discretionary takes a hit during this initial pullback of 2025. I'm back now with Hennian & Walsh Asset Management President and CIO Kevin Mon rejoining us now. So let's get to the stock you like here. And it's one, to be fair, a lot of people like. It's Walmart. The stock's up about 40% over the past year. It hasn't been immune to the pullback that we've seen. The company, of course, recently coming out with a tepid forecast for this year, but you still like it. Looking back at the strength in part that we have seen thus far.
Yeah, I mean, they beat on earnings, they beat on revenues, and that's been a familiar story for Walmart over the past few years. Plus, their e-commerce sales grew by 20%. So not only is their brick and mortar sales doing well, their online footprint is expanding, and that's going to be important in the months ahead.
The company, as we mentioned, did come out with that weaker profit outlook.
Correct.
They talked about the effect of tariffs. They, like many of their peers, are talking about consumer spending potentially weakening.
Yes.
But you think they're going to be okay?
I do. If any of the retailers, they're most well positioned to do well during an economic slowdown because of the diversification of the products they sell. On the staple side, they sell groceries, they sell toiletries, they sell household items. On the discretionary side, they actually sell electronics, technology, and some of the richer apparel items. So I think they're well positioned to handle slowdown and come well coming
Maybe
out.
they'll get a trade down on the more discretionary side?
And then that'll that'll be offset by the staple side.
What about on the margins, though, if they are seeing higher costs themselves?
Yeah, I think those profit margin pressures are going to be short-lived. And if, in fact, we do get the slowdown that the Atlanta Fed is forecasting for Q1, you're going to see more consumers going into Walmart to make these staple purchases.
And then there's another reason that you like Walmart, and that's the dividend that it is paying.
I always like dividends, especially when returns are challenged, as we've seen thus far in 2025. Dividends are an important part of that total return equation. Not a tremendous dividend, but a good, consistent dividend of around 1%.
We always like to talk about what's a reason to be a little more cautious, and that is, in this case, the valuation. And I was looking at the chart of the valuation, and it really has broken out significantly above 30, which is not something that we are accustomed to when it comes to Walmart, 30 times earnings.
Yeah, I'm not the only analyst or portfolio manager that likes Walmart. They're trading at about 36 times current earning right now. That is a little bit rich. They could also suffer a little bit more if the consumer reins in spending, recognizing that 70% of our economic growth does come from the consumer. So 2 areas of concern, but I still believe they're positioned well here.
And as you told us earlier, you're a long-term guy, so trying to look past some of maybe the short-term weakness. Let's talk about the stock you don't like as much. That is Kohl's. And as lovely as the Walmart chart is, that's how ugly the Kohl's chart is. Yeah, the stock is down, I think, 66% over the past year. The latest leg down coming with the company's latest numbers, fourth quarter earnings and revenue down here.
In terms of full disclosure, I was in Kohl's yesterday. I did buy a new wallet and some socks.
Oh, but you don't mean the stock. You were literally in a Kohl's
the store
yesterday.
itself. I didn't buy the stock. I certainly didn't buy the stocks, but I did support the actual business itself.
Gotcha.
I mean, their earnings, their revenue fell sharply in Q4. The outlook for the balance of 2025 isn't that rosy either.
Gotcha. And so let's talk a little bit more about that and also the longer term kind of declines that we've been seeing from the company, because it's not just this quarter.
I mean, this is over the last decade, Jules. We've seen a decline in sales, operating margin. That's why they brought in Ashley Buchanan to try and turn around this whole ship. Time will tell if she could do it, but right now, I'm going to sit on the sidelines and wait.
And this is also the inverse of Walmart in another way.
Yes.
And that's when it comes to dividends.
Never
the company
a good sign.
just cut its dividend.
Cut their dividend from about 50 cents a share to 12.5 cents per share. Perhaps the right thing to do in addition to the layoffs that they announced, but it's concerning to me as an investor.
Right, and doesn't give you a reason, that little bit of a cushion while you ride out some of the
All three of
storm
these
here.
things aren't positives. Clearly.
What could go right here? Maybe they get back, maybe the turnaround plan works and they get back to it.
Yeah, they do pay a dividend. Let's say Ashley Buchanan is successful, turns things around, shores up the balance sheet, they start growing revenues, and they become profitable again. Right now, they're only trading at about 9-time current earnings, so the valuation is very attractive. But the story behind the valuation actually isn't very attractive.
They need to sell a lot more wallets.
A lot more wallets, a lot more socks, and I'm doing my part.
Socks. You are. But we need more Kevin Mons, I guess, in the Kohl's. Thank you so much, Kevin.
My
really
pleasure,
appreciate
Jules.
this. And thank you so much for watching Goodbye or Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern.
With shifting market dynamics in Europe and a reawakening in China, it might be time to start looking outside of the U.S. for attractive investing opportunities. For more, we're bringing in Gareth McCartney, Global Co-Head of Equity Capital Markets at UBS. Gareth, it is good to see you. So let's start with Europe, Gareth, because clearly a lot of investors have decided that's a place to be. They're committing capital. They're moving in. Do you share in that excitement, Gareth?
Sure. Look, there's been a long-running, compelling value case for European stocks. But in the face of the US exceptionalism, compounding very strong performance from US stocks, particularly in the growth segment, and you add in a strong dollar, there's really been a lack of a catalyst to trigger interest in Europe. I think in 2025, we've had 2 catalysts now. I think one is just portfolio repositioning as that US overweight got quite extreme. And then secondly, in the last few weeks, potentially a fiscal story emerging in Germany, which is driving, as really the catalyst to look at value. And you combine positioning and value. That's why we're starting to see Europe outperform this year.
Are there certain verticals in Europe, Gareth, where you see more opportunity than others?
I think the obvious places to look, there's been an ongoing, I think the defense theme will continue to play out. I think infrastructure more broadly. And then the other place that international investors generally look to engage in Europe is around the financials and particularly the banking sector.
Being a capital markets guy, I am curious what kind of activity we are seeing on that front, not just in Europe, but in the US and sort of globally, because we've talked a lot about the uncertainty here, sort of freezing things up to some extent, or at least stalling things to some extent. Is that something that we are seeing everywhere?
Look, I think naturally people look to the IPO market to get a benchmark for activity. What we have seen year to date, which is more encouraging, is pretty much a 20-year high in the volumes we're seeing going through the European blocks market. So we've seen a number of very large billion-dollar plus sell downs of secondary stock as investors look to effectively monetize some of those positions that they've had. So I think European blocks definitely one highlight year to date in terms of volume. The second angle on a global basis would be the emergence of China as well. I think that's been challenging over the last few years. We are beginning to see more activity in the beginning of this year. So there are some green shoots from an overall activity perspective, but there's no doubt that we're still not yet seeing a return to a fully functioning and healthy IPO market. There's a consensus that will happen in 2025 after we saw the IPO market reopen in 2024. But I think this recent volatility pickup that we've seen in the US particularly has likely slowed some of that activity. And I think the real focus now will be on the post-Easter window where companies are ready to come public, but we need to see if the market's going to be receptive to allow that to happen.
Gareth, we spoke to Klarna's CEO not too long ago on this show, and there's a European entrepreneur, obviously very successful guy, very successful founder. I thought his comments on Europe were really interesting, Gareth, and what he said was that, you in the US, he said, you all really celebrate success. You've got this kind of go-go mentality. He said, that's not true in Europe. In Europe, things are different. There is a kind of, in his words, anti-business sentiment in Europe, more pronounced than anything we have here in the US. As an investor, I thought those comments were really interesting. I'm wondering if you agree with them.
Look, I think there's no doubt, the investor base are very global in nature. And really, if they find good investment stories, it's almost irrelevant where those companies are. The capital will flow to those stories. There is no doubt that the US market has been very constructive, particularly for technology, fintech and growth stories. There's a deep capital stack that likes those opportunities, and there's precedent of a lot of companies floating in the US and performing very well. Our view is that the global outlook is more nuanced. I think you need to look at the objectives of companies when they come public. Doing an IPO is a very strategic, long-term decision for any company, whether that's PE-backed or is entrepreneurial and founder-backed. And so we really go back to first principles of looking, what are the strategic objectives of the company? What are the characteristics of the company? And therefore, when you bring those factors to the listing location decision, where is going to be the right home for that company with its specific equity story to really get a sustainable shareholder register that's going to really support that company at the IPO, but then critically in the aftermarket as well. And I think it's our view that Europe has a long history of being very attractive place for certain companies to list. They've IPO'd and then done very well in the aftermarket. Equally, the US has as well. So I think we're less specific that it has to be one or the other, and it comes back to a case-by-case decision based on the equity story.
One area that we haven't talked about regionally is China. So I'm curious to get your take there. Certainly we've seen already publicly listed equities really come back in pretty dramatic fashion this year. Are we also seeing a reopening of the capital markets there?
We are. I think we've seen some significant transactions year to date. So that's encouraging. And then secondly, this period of volatility that we're seeing is triggering global investors, I think, to look at asset allocation and look at some of their underweight regions where there is value on offer and potentially look to deploy more capital, either tactically to cover some of those underweight or more strategically to reinvest in some of those regions. And I think there's no doubt that China would be very attractive from a value perspective. We're seeing that tactical reallocation happen already in the secondary markets, and that's translating into more primary market activity.
Gareth, thank you so much for your time. We really appreciate it.
Pleasure. Thank you.
Coming up, we're joined by an analyst to tell you the best ways to be positioned within the packaged food sector in today's investor playbook. Stick around, much more market domination still to come. The U.S. Federal Trade Commission is reportedly moving ahead with an antitrust probe of Microsoft. This is according to Bloomberg. The move signals that President Donald Trump's new FTC chair, Andrew Ferguson, is going to prioritize still a focus on the tech giants. Microsoft did take a little bit of a leg lower on the news, but it is still in the green today. And this really is in keeping with the other stories that we have seen from now this administration, involving some of the other tech companies that pretty much they're staying the course on some of the already existing probes, investigations, actions.
And not too surprising, right? I mean, if you were listening to Trump on the campaign trail, he would often make that sort of interesting distinction, and we talked about, Julie, between big tech and little tech, and clearly a fan of what he would call little tech. Big tech often, not so much. And Andrew Ferguson, now our man at the FTC, is described as very much a member of that sort of populist wing of the GOP, who tend not to be great fans of corporate power in general.
Right, but it is an interesting distinction when we talk about deregulation by this administration. It does not include this.
Not big tech.
Right.
Yeah, it's the same thing we talked about the M&A lawyers. Like, did you expect M&A in tech? We would have guests on the show would say, in little tech.
Right.
Sure.
Right. Yeah. Exactly. Yeah.
All right, moving on. Let us check Tesla now. That's our call of the day because JP Morgan lowers its price target on Tesla. They go from 120 to 135. The note coming amid a handful of cuts Elon Musk company has gotten over the past week. So JP Morgan does reduce estimates as they say consumer reaction toward the brand intensifies. They now see a second year of lower deliveries in 25 and a third year of lower EPS.
Yes, they say first quarter deliveries are going to fall 8% year over year and something like 25% quarter over quarter. To be fair here, Ryan Brinkman, the analyst who leads their coverage, has had an underweight since February of 2015. I don't know if you know what Tesla shares have done since February of 2015.
Yeah.
But they haven't gone down over that period of time. That said, of course, they have gone down recently. They're bouncing a little bit today, but this is just the latest analyst to come out with this call. The quote for me, he says, "We struggle to think of anything analogous in the history of the automotive industry in which a brand has lost so much value so quickly."
Yikes. Yeah. They explain their underweight rating like this. They say notable investment positive. They list them. They say, listen, a highly differentiated business model, appealing product portfolio, leading edge technology, and then they say, which we believe are more than offset by above average execution risk, rising competition, growing controversy with regard to the brand, and valuation that seems to be pricing in a lot.
Yes. Consumer staples have been having a rough year depending on where you're looking here. The consumer continues to be cautious with spending. Companies in the space like Campbell's cutting their forecasts on weaker demand for snacks. We're navigating how to play the packaged goods sector with the Yahoo Finance playbook. Joining us now, Arun Sundaram. He's Senior Equity Research Analyst at CFRA Research. If you look at the S&P Consumer Staples Group, it's actually up year to date, but it's being pushed up by some sort of things that are one-offs, like Walgreens boots, for example. Overall, we're seeing a little bit more rockiness here, Arun. So I guess big picture, first of all, set the table, if you will, on the dynamics here and how much these companies are at risk from slowing consumer spending.
Yeah, thanks for having me. Yeah, so I mean, overall, like you said, the S&P 500 consumer staples sector has outperformed the broader market this year. In fact, since the market topped in February 18th, the packaged foods and meats sub-industry is actually up 8% compared to the 9% decline for the S&P 500 and the almost 14% decline for the information technology space. So clearly, there's a rotation going on in the market where consumers are flocking to more of these defensive sectors like consumer staples. But at CFRA, we are underweight consumer staples, the sector overall. We have been for the past few years. The past few years have been quite challenging for the sector, rising costs, lower demand. And we think 2025 is shaping up to be another challenging year for consumer staples, especially now that consumer demand is slowing. At the same time, it seems like cost pressures are intensifying, especially now given increased tariff risks. And then you also have policy risks like potential cuts to SNAP or food stamps, That would be a headwind for packaged foods. You also have initiatives like the Make America Healthy Again initiative that could cause food and beverage companies to potentially reformulate products, change packaging, things like that, and that can come at a higher cost. So we do see this year being a tough year for the overall space, and that's why we are underweight.
Arun, you mentioned tariffs. Just specifically there, how do those sort of possibly affect and ripple through that packaged food space?
Yeah, I think tariffs. So overall, I mean, relative to other sectors, industries, I think the packaged food space is relatively in better shape there. Tariffs are more going to be indirect impacts, mainly in input costs like packaging and materials. Think like aluminum cans for sodas and steel for various cans and things like that. But the good thing is like most of these packaged food companies, they do produce products domestically. They have manufacturing plants within the U.S. So there's not as much direct import-export tariff risks there.
So Arun, if we're talking about specific picks here, I'm looking at some of your other picks here. McCormick, for example, the spice maker is on that list. How does that factor in some of the bigger macroeconomic trends that you've been talking about?
Yeah, great question. So yeah, I mean, McCormick is one of those companies where they're not seeing the same type of top line pressure that other packaged food companies are seeing. In fact, McCormick is seeing positive volume growth, which is actually pretty rare to see across the packaged food space right now. And why is that? It's because I think McCormick they compete in pretty fast-growing categories. Spices, for example, people are cooking more at home right now. They're cooking healthier meals at home right now. McCormick also is a big player in condiments, and they have many hot sauces that they own. Cholula, for example. They also, consumers are preferring spice and heat, and they really compete in these fast-growing categories. And we are positive on McCormick. And another part is McCormick also has a portion of their business where they sell ingredients to packaged food companies. And if there's changes to food regulation, I think McCormick could be a beneficiary there if they do sell more healthier ingredients to packaged food companies.
Arun, what about Kraft Heinz? Because that stock. Not been working, Arun. Not year to date, not over the past 12 months. But you say it's a buy. How come?
Yeah. I mean, Kraft Heinz has been one of the more challenged companies. Its stock has been beaten down pretty hard as well. We do think there's better days ahead for Kraft Heinz. We do think probably by mid-year this year that we do see better top-line performance. I don't think they'll see positive top-line growth this year, but potentially by the end of this year, they can start to see better momentum there. On the bottom line, they're a bit more protected. In fact, Kraft Heinz actually has some of the strongest operating margins throughout the packaged food space. And overall, we like them because the company has a clean balance sheet. Their debt is low. They're buying back a lot of shares right now, given how depressed their stock is right now. We do think Kraft Heinz could potentially tap into the M&A markets. I think that's a trend we could see throughout the packaged food space, is more companies acquiring other brands, given that they need to do something to spur the top line. And I think Kraft Heinz, might be a candidate for that.
Arun, you've talked a little bit about some of the push to remove food dyes, some of the potential effects of RFK Jr. in his role, and that these companies are less exposed. Which ones in your coverage universe do you think are more at risk and more exposed to that?
Yeah, no, I think some of these, center store packaged food companies that are a bit more exposed to some of these policy risks. Think like cereal manufacturers. General Mills probably fits that criteria. Kellogg fits that criteria. Even Kraft Heinz, I think, is at risk for some of these policy risks here. But we'll have to see. I mean, the good news is that I think these packaged food companies have been facing changes in food regulation for decades now. And I think they're well prepared to potentially change or reformulate products if that, it does come down to that. A quick example I can give you is, food regulation in the K through 12 school industry has been changing dramatically over the past few decades. And many of these packaged food companies do continue to sell to schools and universities and things like that. And they've had to constantly reformulate or change their ingredients in there. So I think overall that they will be fine. But yeah, it might come at a higher cost.
Arun, thanks for your time, those picks. Appreciate it.
Thank you.
While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.